What are the downside risks for the Federal Reserve of doing even more?
Well, the way I view what we've done so far is, remember, we saw that the financial markets were not functioning well. So we took very strong actions to make sure that the financial markets continued to function so that credit could flow to households and businesses. Without a functioning financial system, we'd have a financial stability crisis on top of a pandemic crisis. So no one would have wanted that. So our actions so far have been, I think, impactful. I think you've seen the financial markets working better. I think liquidity is flowing. And I think those have been important programs that we set up, these emergency facilities. Some of them are still to come in terms of opening for business. The terms are being negotiated with Treasury and to make sure that those programs work well. So that's kind of the state of play there. I think as the economy and more places begin to open up, we'll have a better sense of what the recovery is looking like. And we may have to, and I expect that we'll have to support the recovery going forward. But we're really at the very beginning stages of that because there's still parts of the country that are shut down. So it really depends on what you mean by doing more. I do think there's going to be a second phase of monetary policy, but that'll be more of the supporting the recovery, supporting activity, making sure that we can have a recovery that takes hold and develops.
Well, President Mester, let's talk about that, because quite clearly a couple of months ago, it's night and day compared to where we are now. And I think it would be hard pushed to suggest that it's about market functioning anymore. You've talked about that next phase. If the previous phase, the objective was market functioning, what does the next phase look like? And how are the tools different? How is the response to the Federal Reserve different?
Right. So the way I view it is, just think about the second quarter. The second quarter numbers, when they come out, are going to be very, very negative numbers. I mean, we know that. We know that that was the height of the shutdown when there was no activity. In the third quarter and fourth quarter, we're going to see activity begin to emerge. I think some of the quarterly growth rates are going to overstate what it looks like really out in the field, because we're going to see from a base of very little activity, some pickup in activity, and they're going to look like big growth rates. But we're still going to be below where we were at the start of the year in terms of both employment and output. So I think we have to take this, looking at how this is emerging. I think there's a lot of concern about second waves of the virus. So what makes this difficult is that we have both economics going on and also a health crisis going on. And so that's very different than other economic shocks that we've had in the past. And so I think a lot of how the recovery goes is going to be dependent on COVID testing, the 3 C's: COVID testing, contract mapping, and making sure that the capacity of the healthcare system can handle an increase in cases that every epidemiologist is telling us that we should expect over the second half of the year. That means that the recovery could be slow. When you have so many people out of work, it's hard to imagine that we'd see a quick V-shaped recovery. I think it's going to be slow. I think businesses are going to be thoughtful about reopening. I think people are going to be thoughtful about spending. And so what that means is that monetary policy has a role to play as we support the economy, getting back to our dual mandate goals of full employment and price stability. And so that's more traditional monetary policy, and the tools that we have are our interest rate tool, which already is at zero, forward guidance, which we've used before, and also asset purchases, but asset purchases not to improve market functioning, but really to support the economy as it moves forward towards full employment and price stability.
Well, markets want you to specify exactly when you're going to do what you're going to do, of course. And I'm wondering if the June 10th meeting is a time for you to announce anything new at this point. Your Fed, Cleveland Fed, did a study of the Taylor rule and 5 other simple rules and found that if you used those, you would have the Fed funds rate, your target, anywhere from a -2% to a -14%. That suggests at this point, you're not loose enough for the economy we have at the moment.
Well, I think those rules, right, are based on the dynamics in the economy, based on history and historical relationships. And if I told you that the unemployment rate, which is now at 14.7%, you stick that into a rule, you're going to get that kind of result from the rules. But really, right now, we're not really trying up to this point to stimulate activity, right? The economy was shut down as an investment in our public health, right? That was the tool that the country did to sort of try to make sure that the capacity in the healthcare system could build up, more could be learned about the transmission mechanism of the virus. So the work that we've done so far at the Fed, and the federal government also, was really to get us through the shutdown period, so that when the economy begins to reopen, that's the point where we can support the recovery. And I think that's where the second phase that I was talking about comes into play. We're just at the beginning now of states beginning to reopen. So again, I think we're talking about a future state, right, when we see what the recovery is starting to look like as more of a country is able to reopen. And so I think we're going to have those conversations. But again, I think that comes at a later stage when, right, we know a little bit more about what that recovery point is looking at. And we're collecting data all the time on how the reopening is going. So we have some, information on that, but really beginning stages of that for the country.
Well, you, the Fed, have long suggested that forward guidance is kind of the next tool that you would employ. But when you look at two-year Treasury note futures, they're under 1% out to the end of 2022. And it's raised a question in people's minds on Wall Street. If you give traders just a one-way bet forever, you're going to have problems down the road. You're going to have a taper tantrum if everybody is in on the same trade for years and years.
Yeah. So I think that's always a concern when we're using these tools at the zero lower bound. We always, whenever we use a tool, at least the way I approach this, is we always have to think about what it looks like at the moment, but also what does it look like in the future, and how would you exit from that tool? So I always approach policy that way, not just looking at the current moment, but also thinking about, okay, what's the path of this going forward? And that's really going to be decided by what happens in the economy. What does the recovery look like? How much accommodation, monetary policy accommodation, is needed, right? And then also communicating well so that we're not surprising anyone with our policy. That we want people to understand where we're coming from, what our rationale is, but we don't want to necessarily mislead in some way by saying we know exactly how the economy is going to evolve. And so that's when we got into earlier in the earlier recovery, it was about making sure that people understood that we're not prescient, but we are going to base our policy actions on what the data is telling us about the economic outlook.
Well, President Mester, at the moment, there are people worried about how big the Fed's role is in clearing markets now and how big the Fed's role is in setting prices. And there's been a conversation in the last several weeks with us and your colleagues, including President Williams, about yield curve control. I want to try and understand from you, because this is where the confusion is on Wall Street for some people in fixed income at the moment. Would yield curve control for you be something focused on the front end to the belly of the Treasury curve? Or would you think about doing what Japan is doing, which is all the way out to 10 years? Just how much control over the yield curve, so to speak, would you be looking to have?
Right. So my view of yield curve control is that it really is a support for forward guidance if we were going to do it. Now, the committee has discussed yield curve control as a tool back in 2010 during the financial crisis, and then also as part of our framework review as a tool, a potential tool. No decisions have been made on that at all. Again, I don't think of that as something that would be in this phase of what we're doing to make sure that the markets continue to function. But as a tool, I think it's worthwhile thinking about what those tools are going to be that we can use. But right now, that's a discussion for the future phase. And my own view is that if you wanted to do it, you'd have to think hard about how you would implement it. And also, as I said before, how do you exit from it? Because with any of these tools, right, there are pros and cons of using them. Right now, as you point out, the yield curve is very flat at the short end. So maybe with the forward guidance we've given already, it's not necessary to do something to emphasize that forward guidance. But I don't want to take it off the table as something that's a potential for me to think about as a possible tool. I just don't see that we need it here in this space, nor do I see going forward that we necessarily would need to use it. But if we were to use it, I would view it as a reinforcement for forward guidance on the short end.
Before we let you go, I have to ask you about this. There is the possibility we could end up in a new trade war with China, additional tariffs going on. How would that affect the economy? Have we already absorbed that, or would that be a new hit to the economy now?
Well, I think, whenever there's a new rising up of uncertainty, and this is another uncertainty, I think we have to take it on board as being another potential headwind to a recovery. So I think we have to just use that as part. We have to take the conditions as they are. I think that we played this game before and sort of saw how the uncertainty did dampen the expansion earlier, and so I think we have to just take that on board as this is another uncertainty added to an incredible amount of uncertainty we already have.